Answer is no. What's happening right now in the US banks is different from what has happened in previous recessions. In previous recessions, US banks continued to lend all through recessions, all throughout the recession. This is a plot of consumer credit outstanding during the periods or just after recession in the US. In 2001, they continued to lend. In 1980 to 1982 period, after a short period of contraction, they started lending again, and loans outstanding started climbing again. In 1991 to 1992, during that recession, there was a bit of deleveraging. There was a financial crisis at that point. Some of you may be aware that during 1981 to 1982, 1991 to 1992, the US also went through a banking crisis, and their loans were flat. The loans didn't grow during that period. The banks also had problems there, the savings and loan crisis. But look at what's happening right now. In 2007 and to 2009, the banks, after continuing to lend for the first 10 months after the recession started, the loans then peaked out. Now it's collapsing. Last month was particularly bad. In December, the loans virtually collapsed. So banks, in one word, banks are not lending in the US. If they don't lend, then they have no source of income growth except through trading. And what do we know? My colleague Calvin pointed out that the US stock markets fell 200 over points, the worst in the year, on Thursday night. What happened? Because President Obama made a proposal to restrict the bank from trading. And that means he's going to strip the bank of the most profitable part of their operations, trading income. We know that traditional bank lending, they're not lending. And they won't make money from lending because the NPLs are rising. So, if you strip the trading income from their income statement, they're not going to be able to make money. That's why the stock market reacted so badly. 200 over points down. Okay? And what's up ahead in the current financial year? Maybe I should pare down this worries about this development. And that's the return of some assets back to bank balance sheets that's coming up this year. Some of these are off-balance sheet assets, but under new accounting rules, the banks have to bring them back on their balance sheets, and therefore that will keep their capital adequacy ratio under some constraint. That will pressure the capital adequacy ratio. Okay, another point I want to make is, whilst the banks seem to be reporting better credit numbers, especially if you read the statements from Bank of America, they say the worst of the credit cycle seems to be over. Well, this chart tells you that may be an understatement. We may be in the middle of the eye of the hurricane. For some of you who keep abreast of hurricanes, developments of hurricanes, what do you see at the eye of the hurricane? A period of calm. So that's what we're seeing. Bank losses from NPLs after rising sharply would have fallen right around now to a kind of a slow period, and then it will start to pick up again. Because why? Because the adjustable rate mortgages are coming in. These are the loans that were given out at teaser rates, so-called BLR minus 2% for first year or for 2 years. All these loans are being reset. They're coming in for reset. They'll be reset all the way until end of next year. So we can expect, or we can worry that some of these loans that are being reset to higher interest rates will suffer rising NPLs. And that's what will be implied by this period of rising amounts of adjustable rate mortgages coming due for adjustments in the 1 to 2 years ahead. Okay. The second reason that gives us clear worries is the US housing market looks like it is stabilizing right now. It looks like it's stabilizing, but the reasons for it stabilizing are not very encouraging. It's stabilizing because the do I have it here? Yes. The Federal Housing Administration actually guarantees mortgages in the US. They guarantee between guaranteeing mortgages and outright giving out loans, federal agencies account for about more than 50% of all housing loans in the US. That means unless the government supports the housing industry with guarantees against defaults, or the government itself gives out the loans for housing loans, there will be no housing market in the US. Okay, for some of you who may have been keeping track of the developments at Fannie Mae and Freddie Mac, which are the two federal housing agencies that support the US housing market, these two agencies are coming to limit as to how much further they can support the housing market. They have suffered losses of more than 100 billion. The president has had to increase the maximum ceiling of support that the government can give to these two housing agencies. They've just raised it by another 200 billion. The big question mark is, can they continue to do that if these two housing agencies continue to run losses? 100 billion, you can support them. 200 billion, you continue to support them. When they run to 3, 4, 500 billion, can you still continue to support them? Okay? There's a question of political will there. I'm sure if the government in the US printed money, they can continue to do it. But will taxpayers be willing to fund that? There's a question of how it can go through Congress. Some of the things that seem to be supporting the US market, like the federal tax credit, $8,000 for first-time house buyers, that is in fact one of the things that's supporting the US market, but that program ends in April and may not therefore continue to provide any support for the US housing market. On the flip side, we also look at the unemployment rate in the US. For some of you who read every Thursday's report for unemployment rate in the US, this is what they report. The figures seem to imply that the unemployment claims are falling. After peaking out, they're falling very sharply. But behind these statistics is another reality, a different reality. And that reality is that a lot of people who claim unemployment insurance in the US, the maximum period is 73 weeks right now under extensions of these unemployment claims programs. If we include these extensions to 73 weeks, the normal one is only 1 year, 53 weeks. If we include the extensions, this is what the unemployment claims look like. It's tremendous. So for some of you who have friends in the US, they can tell you the unemployment rate is mind-boggling in the US. This is without doubt the worst since the Great Depression. Okay? The real unemployment rate, if you include people who are forced to work part-time, not because they want to, but because they cannot find full-time jobs, the unemployment rate is about 17.3%. The official unemployment rate is 10%, and it's 10.4% in December if you don't take into account some people who actually gave up looking for jobs. And if you took into account people who are working part-time because they can't find full-time jobs, then it's 17.3%. Okay? There is some hope. There seems to be some attempts at some positive indications from the average work week that there will be a revival of hiring in the US. That's indicated by the black line. There is some recovery in the work week. Employers are likely to start hiring full-time workers again, but this picture shows whilst the forward look is that things won't get worse, may get better, the current picture is a disaster. Okay? And if you think that the US employers, from the official statistics I pointed out previously in the previous chart, that